Hi, I'm Jonathan DeYoe with DeYoe Wealth Management in Berkeley, California. Today we're going to talk about what your balance of stocks to bonds should be as you near retirement. First, this may perhaps be too simple a question given where we are in the world. So the first thing I'd like to do is tease out a couple implications in that question. The first implication is that the balance should be just between stocks and bonds, and there aren't other things that you should invest in. We've said this many times, we believe that you should be broadly diversified and include asset classes other than just stocks and bonds. The second thing is the vast majority of folks that are currently professionally managing money have done it only within a long-term bull market in bonds that started in 1982 and, while hasn't yet ended, must be near to ending. In 1982-1983, Volcker, who was then the Fed president, broke the back of inflation. Now, when he did this, he set off a long-term bull market in bonds. And from that moment, where the federal interest rate was about 15–16%, it has dropped to about 1.5%. Now, what that means is there are two things that means. First, if you buy a traditional bond portfolio today, it's not paying you nearly as much as it did then. So it's not giving you a lot of return for the risk you take. And the risk you take is one that rates will go up. And this, again, is not a question of if, it's a question of when. And when rates do go up, the value of the bonds you own in a traditional bond portfolio will go down. And so the entire history of investing using stocks versus bonds as your measurement stick might be changing here in the near future. The traditional percentage of stocks versus bonds in a nearing retirement portfolio is a basic balanced portfolio where you have 60% perhaps in equities and 40% perhaps in bonds. Now, again, the reason this might be called into question today is because we're at the end of a cycle in bonds. So you may want to consider finding other tools to be the ballast for your equity portfolios. The important thing to realize is that equities will always go up and down, but the tool that we've often used to protect ourselves has been bonds, and that too can go down. I'm not saying don't use bonds or other fixed income instruments. I'm saying that use them wisely, get some advice, understand the trade-offs. FINRA, one of the regulators in our industry, recently did a study, and that study showed that 79% of people do not understand the relationship between interest rates and bond prices and don't understand the risk they're taking when they're buying bonds. So definitely be broadly diversified, definitely have equities, have some portion in fixed income, but also entertain other ideas, other asset classes that fit into your overall portfolio. I'm Jonathan DeYoe, DeYoe Wealth Management in Berkeley, California. Thanks for listening.